The sell-off is pretty swift at what you're looking at here. Have your thoughts changed at all about the direction of travel given the latest data we've seen and the market sentiment, the repositioning you're seeing among traders, or do you buy the dip?
Yeah, I don't think our fundamental view has changed an awful lot, actually. A lot of it, I think, is positioning driven. When we look at CTA positioning, for example, in equities, that was as long equities as has last been during that meme craziness in summer 2021. So there's a bit of positioning clearing. We are, of course, seeing most of the setback is driven by tech, right? So it's not really driven by the most cyclical names and getting beaten up. No, it's mostly really a tech-driven sell-off. It's mostly that repositioning, that sort of overhang that we had from systematic investors. And honestly, when we look at the fundamentals, even at the payrolls today, I get it. Yes, they've been weaker than expected, but it's not like we've lost 100,000 jobs. In fact, when we look at something like Challenger job cards, they're still almost as low as the absolute lows from the 2010s, which I think were sort of December 2015. When we look at the layoffs, the number of layoffs, they are still lower than the absolute lows from the 2010s. So what we're not seeing is that the unemployment rate is going up because really companies are shedding jobs everywhere. I get it that the job cards from the likes of Intel, they're grabbing the headlines, but on aggregate, we're not seeing those broad-based layoffs yet. And that doesn't, for me, change the fundamental bullish picture then.
So, Max, you think about the phrase of the day, growth scare. It sounds like you're not quite buying into that.
No, absolutely not. I don't buy into it. I do think that actually the 50 basis points rate cuts in September, that is now being touted, that is really a bit overblown, that those fears or even fears of an intra-meeting cut that really aren't justified. Think about Q2 GDP growth. We saw an almost 6% nominal GDP growth. I don't know if that qualifies as recession. I don't know. I might have skipped my lectures at uni too much then. But when we look at the earnings season, of the Q2 reporting season, we're talking about a 14% earnings growth year over year. We're talking about it that it's more broadening out. We're seeing an almost 80% beat rate. We're looking at sort of surprise factors on the earnings side of more than 4.5%, which is bang in line with average. So on aggregate, things are still pretty fine, right? They are decelerating in some pockets. There are some cracks in some pockets, absolutely fine. But that doesn't automatically equate to a recession is coming.
So what is the trading strategy at this point in time? To the point that you're making here, it's pretty interesting. If you look at the S&P 500 today, you do have most sectors here in the red, but you do have a little green on the screen. And in some areas of the consumer, you still see some green in real estate. So interest rate sensitive sectors, if you get a relief, then perhaps you can see a tear in some of the more badly beaten sectors. Is there still a rotation to be had, even if that rotation may not be the same type of rotation that we've seen maybe even just a week ago?
Yeah, I don't think that rotation from a week ago still makes sense. I really don't think that sort of Russell 2000 or US small cap rotation made an awful lot of sense, because if indeed growth is slowing and you're buying small caps just because of the notion of lower yields, then that's really just on borrowed time. So I don't think that rotation into the Russell, where it was really, let's remember in the Russell, there's almost 40% of the companies that which the debt is on a floating rate, so slightly higher yields, pricing out 50 basis points of rate cuts in September would really hurt them. And we know that almost 40% of the companies don't make profits. So that rotation doesn't make sense. In fact, I still am pretty positive, and we continue to be pretty positive on the tech sector. Whereas, three weeks ago, it was all about AI, and it was all about AI, and everything was great. Now it's all about, well, are they really making money out of it and all this sort of stuff? Well, in fact, that correction, what we've seen right now, that positioning overhang that is now being cleared, that's probably more of a healthy correction. And you probably want to more lean into that rather than really throw in the towel there.